It's time for another Friday update with your old pal Millennial Moron. I've got 3 stories for you this week, including an update on one of the lesser-known things going on with the Bank of Canada. First up, the GDP numbers for November were released and we beat projections slightly with a month-over-month growth of 0.2% and a new projection of 0.3% for December, which would give us an annualized growth rate of 1.2% for the last quarter of 2023. However, RBC economist Claire Fan says these numbers should be taken with a grain of salt, as a lot of the growth was associated with things like the end of maintenance-related shutdowns and labor strikes, which are one-off effects that won't be sustained going forward. On top of that, even if we do hit the new projection for December, this would still give us a 6th consecutive quarter of decline in real GDP per capita, so the average person is still going to be worse off economically. RBC also released a report on consumer spending with some interesting data from the third quarter of last year. It turns out that only households in the top 2 income quintiles, or the richest 40%, were able to save any money during the third quarter. The bottom 60% has negative savings, meaning that they spent more than they earned, with the bottom quintile being hit the hardest. On top of that, the household debt service ratio is expected to continue to increase, although at a slower pace than it has been in the past year and a half. StatCan also released their household debt numbers for November, so I took a look, and while overall household debt only increased by about $8.5 billion in November, leaving us still just a bit over $2.9 trillion in total household debt, credit card debt accounted for $3.6 billion of the increase, or about 40%. We normally do see an increase in credit card debt at the end of the year, followed by a reduction in January, but this is an unusually large increase for a single month. I decided to plot credit card debt over the past few years, and it looks like we're back to the long-term trend, or maybe a little bit higher. But it's been increasing very quickly over the past 3 years, which suggests to me that households are running out of savings and transferring their extra expenses back to forms of debt like credit cards as a short-term coping strategy. This is going to be another important one to watch over the coming year, because if credit card debt doesn't start to stabilize, it's an indicator that households are under an unusual amount of financial stress. Next, Ontario has announced that they're going to require that universities and college guarantee housing for incoming international students. A lot of people were asking me what we could do to regulate study permits better, and this is actually something I was going to suggest in response, so it's a nice surprise to see it being implemented. In my opinion, it's a sensible measure that'll help to ensure that we have infrastructure in place to support students, and puts the onus on post-secondary institutions to actually provide a dignified study experience, rather than just treating international students as a source of easy cash with no strings attached. In a surprising show of cooperation between different levels of government, the federal government has expanded the low-cost apartment construction loan program to cover student residences as well, which will help Ontario colleges and universities actually comply with the new rules. I'd go so far as to say they've achieved the minimum level of coordination that we should expect from our government. Now, obviously the devil is in the details of exactly how these policies are implemented, and it doesn't do anything to address the budgetary issues that are going to arise at universities and colleges as a result of the upcoming study permit cap, but it's encouraging to see some progress actually being made, even if it's happening years later than it should have. Finally, remember 3 weeks ago when I told you about the Bank of Canada's overnight repo operations to inject liquidity into the banking system? Well, the news media has finally caught on and started reporting about it. Incidentally, as far as I know, the first person who broke this story was mortgage broker Mark Mitchell, and he's got a few good videos on it if you want more in-depth info on this issue. The basic explanation is that the repurchase, or repo market, is where banks lend money to each other on a very short-term basis to cover daily transactions. Since the beginning of January, the rates they've been demanding for these loans have been running above the Bank of Canada's target rate, so the bank has been stepping in on certain days to inject liquidity overnight, usually to the tune of $5 or $10 billion, to help keep the rate on target. However, even though they've been doing this, the overnight lending rate between banks, which is what the Bank of Canada's policy rate is targeting, was running about 5 basis points above the target rate during the last half of January and hit 7 basis points above the target on January 31st, which is not exactly great. It means that there's a shortage of liquidity in the system. This is a problem because the Bank of Canada is currently in the middle of a quantitative tightening program, meaning they're trying to remove liquidity from the system to suppress inflation, and to undo the liquidity injections into the market that happened during 2020 and 2021 to keep the financial system running. During that period, settlement balances at the Bank of Canada rose from $250 million to about $400 billion. As of now, they've fallen to about $114 billion, but the bank would like to get that down to something in the range of $20 to $60 billion. Again, this is a complicated subject and I'm still reading papers on it, but basically this is money that is injected into the payment system to circulate during the day, but is deposited back to the Bank of Canada at night. The problem with this situation is that, essentially, the Bank of Canada isn't finished with their quantitative tightening program yet, but it seems like there's already a shortage of liquidity in the banking system, so we may need to stop quantitative tightening and return to inflationary monetary operations and inject more liquidity to keep the interest rate from creeping up above the target. This puts us in a very awkward spot for monetary policy because it means that we're being pulled in opposite directions in terms of controlling inflation versus maintaining the target interest rate. Now that traditional media has picked up the story, there's a good chance that the Bank of Canada will address this in their March or April meeting, so like I said last time, it's a good one to keep an eye on. That's all for this week, so as always, thanks for watching and enjoy your weekend.